Hello. In this lecture, we're going to present a case study related to refinancing a home mortgage. This is an actual case that happened to one of my faculty colleagues about 7 years ago. We'll first describe the homeowner's situation and how the problem evolved. Then we'll talk about selecting a criterion, whether it would be present worth, future worth, annual worth, rate of return, and so on. We'll describe both the existing loan and the refinancing option in some detail. And in order to make the comparison, we're going to define a new alternative, which is really a new criterion. We will finish by doing a break-even internal rate of return analysis. Here's the situation. One of my colleagues recently bought a home and got a 30-year mortgage. About 2 weeks after moving into the house and starting with the loan payments, or at least planning the loan payments, this person was presented with a refinancing opportunity and was made aware of a 15-year loan at a lower interest rate. So the question is whether one should refinance at this point. First, there's a psychological question. You've made a big commitment in time and energy to get the first mortgage, and should you go through that again? But let's look at the financial aspect of this particular problem. The question of refinancing deals with really, do you need to take advantage of the lower interest rate? And if so, will it offset the transaction costs? Because there are closing costs involved with the refinancing. Plus, there are higher monthly payments because of the shorter term. So let's talk about criteria. Could we use future worth, present worth, or annual worth? This is difficult for individual decisions because it's not clear what the minimum attractive rate of return would be. It's difficult to determine what the alternative investment opportunities are for an individual. Should one use a money market rate, stock fund rate, certificates of deposit, or if one is paying on credit cards, should one use the rather high interest rate? Similar problems come with the benefit-cost ratio. How do you classify benefits when you're refinancing a mortgage? Everything is an expense, so it's not easy to develop a benefit-cost ratio. If we're doing internal rate of return analysis, then we're likely to have some very long periods, 180 months, 360 months. This presents a problem in terms of computational effort. Further, there's the question of what do we compare that with? If we develop an internal rate of return, we need a minimum attractive rate of return for comparison. So the same questions that arose with the present worth, future worth, annual worth criteria will arise with the internal rate of return. Nevertheless, in this case study, we do apply to a 60-month period. That's a 5-year period. We develop another criterion, which is basically the future cash amount. And this criterion is developed specifically for comparing the existing loan and the refinancing option. Let's talk about the existing loan. First, the loan was for $202,000. So perhaps the purchase of the home involved an expenditure of somewhere around $240,000 to $250,000. The difference, of course, being the down payment. The time period is 360 months. Most home mortgages are paid on a monthly basis, so that's 30 times 12. And in this example, the interest was expressed as a nominal 9% per year. So dividing that by 12 gives us the effective interest rate as 0.75% per month. So the monthly payment for the principal and interest, this was a level mortgage, that is, the monthly payments were the same throughout the life of the loan, is determined by taking the mortgage principal, $202,000, or multiplying it by the capital recovery factor for 360 periods at the periodic rate, 0.75% per month. So that results in a monthly payment of $1,625.34. That's the existing loan. Let's now look at this graphically. We see a very large sum of money being transferred from the mortgage company to the homeowner. Of course, the homeowner immediately turns around and gives that to the seller of the home. And then, in turn, the homeowner promises to pay for a very long period of time, $1,625 a month. The mortgage company would call that a monthly payment that includes principal and interest, or P&I, as it's sometimes called in the mortgage loan business. The new loan would be for the same amount as the existing loan, but the monthly interest rate is lower. It's 0.625% compared to 0.75. Also, this is a shorter term, so there are 15 years involved. In addition, we have a transaction cost or closing cost, which really represents attorney's fees, appraisal fees, and other types of paperwork fees involved in refinancing a home mortgage. So here graphically we have the new loan or the refinancing option presented. We would get $202,000. Of course, we would turn around and pay that to the other mortgage company from which we originally got the loan, the 30-year loan. In addition, we pay the transaction cost, $2,000, and then we promise to pay for 180 months $1,872.50 per month. That's, again, principal and interest. So that describes the new loan, the refinancing option, which was presented as an opportunity. So the question is, how do we compare these two options? Well, very few people live in a house long enough to pay off a 30-year mortgage. I think the mean time of ownership in a home is somewhere between 5 and 7 years. So one way to compare the two alternatives is to calculate the remaining loan balances after some period of time. And we can do this for 5 years, 10 years, and 15 years. So let's look at the existing loan. Let's say after 5 years, we've been making these payments, $1,625 a month. That's for 60 months. And then after that period of time, we still owe 300 payments to the loan company. So from the viewpoint of the loan company, the remaining loan balance can be viewed as the present equivalent after month 60 of these remaining 300 payments. And that turns out to be the sum of $193,678. Let's see how that is developed using our formulas. We have the monthly payment, $1,625 per month, and we're taking a series present worth factor at the mortgage interest rate, 0.75 per period for 300 remaining periods, and that gives the remaining loan balance after 60 months, after 60 payments. And we can do similar calculations for 10 years later down the road. Then the remaining balance is $180,648. After 15 years, approximately $160,000. And this slow decline in the loan balance is typical of 30-year mortgages. Notice after half the loan period, after 15 years, the homeowner still owes almost 80% of the original loan, somewhere between 75 and 80%. Let's look at the new loan. Well, that's similar. After paying 60 payments on the 15-year mortgage from the refinancing, we still have 120 payments left. So the present equivalent after month 60 to the loan company of the remaining 120 payments is then $157,753. And the formula for that is very similar. We take the monthly payment, the $1,872.56, take a series present worth factor at our mortgage interest. This is a lower mortgage interest rate, 0.625 per period, and the number of periods remaining is 120. And we can do that for 10 years later. Then we have only 60 periods remaining. The present equivalent of that after month 120 would be $93,451. And of course, after 15 years, there's a zero balance because the 15-year loan would be paid completely. The problem now is how to compare this, because we really have apples and oranges. What we're doing is with the refinancing option, we're paying more per month. In addition, we're paying a closing cost of $2,000 at time zero. So we really can't compare these two options. What we can do, however, is construct a new option, a hypothetical alternative. Let's call that option 3, where the homeowner keeps the existing mortgage contract, keeps it at the same rate, 0.75 per month, but replicates the cash flow of the new loan. And the excess payments then go to reduce the principal balance. Most mortgage loan companies allow you to do this without penalty. Then we can make a comparison of the remaining loan balances. So let's do that. Let's take our hypothetical alternative, option 3, where we keep the loan interest rate, 0.75. We're sticking with the original loan contract, but we're taking the money that we would pay for closing costs, attorney's fees, appraisal fees, and so forth, and reducing the principal balance. We do that, and we also do the same thing with the additional $247 per month. That's the difference between the two loan schemes, the original loan and the refinancing. So that with the original loan amount of $16.25 per month, plus the additional $247.22 per month, we reach the same monthly payment that we would had we refinanced. But we're going to take these additional amounts, the $2,000 and the $247 per month, and use those to reduce the principal balance. That, of course, will reduce the period of the loan. The loan will be paid off sooner, and it will also affect the remaining loan balances after 5 years, 10 years, and 15 years. So let's do that. Let's see how much the effect would be. Well, there are two of them. The first effect is the $2,000. That's a single amount at time zero, and we want to determine the effect on the remaining loan balance 5 years later or 60 time periods later. So we can translate the $2,000 using a single payment, future worth factor, F/P factor for 60 periods, and it would have the effect of reducing the loan balance by $3,131. We paid it to the mortgage company at time zero. The effect of the monthly $247 can be determined by using a series compound amount factor. We take the $247 per month, apply the F/A factor, that's the series compound amount factor for 60 time periods, and the effect there then is $18,646. We can do the same thing for 10 years later and 15 years later. The effect of the $2,000 10 years later is $4,903. 15 years later, the effect is $7,676. The monthly $247 translates into $47,841. That's a reduced loan balance 10 years down the road. And if we keep it up for 15 years, then the loan balance would be reduced by $93,549. So then the next step would be to actually compute these remaining loan balances for our hypothetical alternative, option 3. So let's do that. After 5 years, originally that loan balance would have been $193,678. The $2,000 has the effect of reducing it by $31.31. The monthly payments, the additional monthly of $247, has the effect of reducing it by $18,648. So that has the total effect then of the reduction to $171,901. If we compare that with the refinancing option, there the amount is $157,753. So our conclusion is that if the homeowner can make the payments, that is, if the higher payment is not a financial burden, and if the homeowner is going to stay in that house for at least 5 years, it would make sense to go with the refinancing option rather than keep the existing mortgage contract and simply accelerate the payments as we described here. Now let's look at 10 years down the road. Originally that loan balance would be $180,648. The effect of the $2,000 is to reduce it by $49.03. The monthly $247 reduces it by $47,841, resulting in a new loan balance of $127,904. This is 60 months after the beginning of the loan. If instead the homeowner had refinanced with a new loan, that is option 2, that loan balance would be $93,451. Same total cash flows, lower loan balance. Looks like option 2 is the better choice here. Looking 15 years down the road, we get the same type of conclusion. Originally $160,248. The $2,000 reduces that by $7,676. The $247 per month reduces it by close to $94,000. The new loan balance, of course, would be much reduced from the original $160,000. It's now around $59,000. However, the refinancing option would result in a loan balance of 0. So again, the conclusion is that the new loan is better than the hypothetical alternative. Now let's go ahead and bite the bullet and do some internal rate of return analysis. Let's define option 4, where the homeowner keeps the existing mortgage contract but takes the excess payments, the $2,000 at time 0 and the $247 per month and puts it into an account that grows in 5 years to this specific amount, $35,925. And that is the difference between the remaining loan balances between options 1 and 2. Option 1 being the existing mortgage contract, option 2 being the refinancing option. So if the homeowner can achieve an internal rate of return on this amount deposited at time zero, the $247 per month, and let it grow at up to $35,925 at some reasonable interest rate, then perhaps that's something the homeowner should consider. So here we have graphically this presented. We have the $2,000 that the homeowner deposits into some fund. We're not saying what type of fund it is. We're just saying it needs to be some type of growth fund, perhaps. The $247, 22 cents per month. And all of that has to grow to $35,925 after 60 months. So we can use a trial and error routine or an iterative procedure to find the growth rate that makes this happen. And it turns out to be a little more than 2% per month. In fact, 2.084% per month. We can take this monthly rate and compound it up to the 12th power, subtract the 1, do our conversion to an effective annual rate. That gives us an effective annual rate of 28%. Now, in the last several years, there may have been people who have achieved that rate in mutual funds, but it's a typically high rate, and it's one that's not likely to be achieved by a typical homeowner year after year. So considering that the break-even rate is 28%, it looks like the new loan would be preferred for the typical homeowner. So let's summarize what we've presented in this lecture. We defined a new criterion, future cash, which is useful in this particular case, and it's useful in other situations, because it avoids some of the issues such as what is the minimum attractive rate of return. We applied this criterion to the existing loan by computing the remaining loan balance. We applied it to the new loan. We computed remaining loan balance after 5, 10, and 15 years. And we applied it to a hypothetical alternative where the homeowner kept the existing mortgage contract but accelerated the payments to duplicate the cash flows with this alternative as would be with the new loan. And those comparisons resulted in the conclusion that the new loan would be preferable if the homeowner stays in the home at least 5 years and does not have any difficulty in making the higher payments. In this particular situation, this homeowner was married and the spouse was earning a professional income, so there was not a financial burden on that particular family. And then we did a rate of return analysis for the 5-year period. And remember, this was done on the difference between the alternatives. We looked at the $2,000 at time zero and the $247 per month. And that rate of return analysis resulted in a break-even rate of return of 28%, which is not likely to be achieved by the typical homeowner. So that reinforces the conclusion we achieved with our new criterion, future cash. So now that we've presented this method of looking at refinancing, we hope that when you're presented with a similar situation, that you'll be able to apply similar techniques and hopefully reach the proper conclusion.